Okay, so we are going to be having adjusted present value. Uh, Again, one thing you need to understand is that APV is very technical. All right, APV is very technical, unlike the net present value. So just take your time to understand the concepts. All right. So once you understand the procedures and the underlying procedures for calculating APV, then you can be rest assured anywhere the question comes, you'll be able to tackle it. All right. But uh, again, as we proceed, you may be thinking otherwise on the concept of APV, but just take your time. After today, go over the concept again, and then you understand. It's not difficult. I will take my time to explain it to you. So let's talk about adjusted present value. Now, what do you mean by APV? APV is a technique designed principally to evaluate a project where financial risk or debt equity proportion of a company are expected to change as a result of undertaking a project. Okay, I repeat, adjusted present value, APV, I won't write too much so that cover we can cover the relevant concept today. So adjusted present value is a technique, okay, designed principally to evaluate a project, where financial risk or debt equity proportion of a company is expected to change as a result of undertaking a project, as a result of undertaking a project. Okay, so that is APV. Now, okay, that reminds me. I'm not sure Tayo is in this class. TY, that you just crossed my mind. Let me see. Tayo is not in my class. Oh, okay, he's around.
I'm
Okay.
here.
Okay. You just crossed my mind now. All right.
Well done, my
Okay.
brother.
Yeah. So move on. Now, I said that APV is a technique designed principally to evaluate a project where financial risk or debt equity ratio of a company is expected to change as a result of undertaking a project. Now, the APV and the NPV are similar. Okay, let me put it down for you. The APV and net present value are similar. However, however, APV should be used. APV should be used to evaluate a project. To evaluate a project where issue costs, or subsidized loan, subsidized, is given. Now, what am I saying this? As far as APV is concerned, or as far as NPV is concerned, NPV does not concern itself with issue cost or subsidized loan. NPV is less concerned with whether you have subsidized loan or issue cost. So it is only adjusted present value that that uses issue cost and then subsidized loan. So if in a question you can see anything like issue cost or subsidized loan, an examiner is asking you to evaluate a project, then you should know that you are supposed to use adjusted present value to evaluate, because oftentimes examiner will not tell you to calculate adjusted present value. It is implied in the question. The method you are going to use to appraise the project is implied in the question. So, but what I'm now saying is that once you can see issue cost or subsidized loan or subsidy, then you should know that this is adjusted present value. This is adjusted present value. Okay, so that's the only thing that differentiates APV from net present value. Issue cost or subsidized loan uh, is the one that differentiates APV from NPV. All right. So the APV is a technique that separates. It's a technique that separates the cash flows, the cash flows from operation, from operation, from the cash flow, from the cash flow arising from financing, and appraise each independently. So what we are saying as per APV is that when you want to use APV to evaluate a project, there are two stages. So the cash flows will be divided into two. One side is the cash flow arising from operation. The other side is the cash flow arising from financing. So you are going to evaluate the cash flow from operation separate. You also evaluate the cash flow from financing separate. Then you now marry the two together to get your APV. So because of time, let me quickly show you the procedures. Okay, procedures involved in calculating APV. Steps, or let me call it procedure, involved in calculating adjusted present value. There are four steps. There are four steps you are supposed to undertake anytime you want to compute APV. Step A, let me call it A. Step A is to calculate base case NPV. Calculate base case net present value. Okay. Then B, calculate present value of financing effect cash flow. Present value of financing effects cash flow. Then C, determine adjusted present value. Then D, advise on the acceptability of the project. These are the four procedures that you need to carry out anytime you want to compute adjusted present value. You know, life would have been very easy for us or for you on the day of your exam. If you are asked to calculate adjusted present value, or you just carry out the four procedures I've given to you on the screen. Okay, you just go ahead, go to the question, straightforward. Calculate base case NPV, calculate present value of financing effect cash flow, determine the APV, then you advise on the financial viability of the project. But it's not going to be like that. It's not as easy as I just called it. So there are a lot to be done under each of them, particularly the A and B. Therefore, how do you then calculate base case NPV? Let's pick it one by one. So number A, base case NPV. To calculate base case NPV, you are going to carry out about 4 or 5 procedures. So step one, uh, you determine relevant cash flows, all right, or calculate net cash flows. Calculate net cash flows. Let me write it out in full. Okay, e.g., or considering calculate net cash flows, considering the sales value, considering sales, variable costs, incremental attributable specific fixed costs, working capital, initial outlay, okay, inflation, taxation, etc. All those things you normally do, all right? All those things you normally do when you are computing the NPV is the same thing. So when you have to calculate base case NPV, it's the same thing as your normal NPV, the same way you calculate normal NPV. The only difference is that instead of you to use the company's cost of capital to discount the net cash flow, you are going to use cost of equity on gear. All right. So that's step one. Just go ahead and calculate the net cash flow. All right. The sales value minus variable cost minus fixed cost. You have your profit. You apply tax liability. Okay. Tax saved on capital allowance, scrap value, initial outlay, working capital. Then you get your net cash flow. That's the first step. Then step two. Uh-oh. Okay. Step two is to calculate cost of equity on gear. So, step two, you calculate cost of equity on gear. Calculate cost of equity on gear. KEU. That's the cost of equity on gear. How do you calculate cost of equity on gear? Okay, let me put it this way. Calculate cost of equity on gear depending depending on the information depending on the proxy information available. Proxy information available. Okay. Now, there are 3 ways you can calculate your cost of equity on gear, depending on the information of a proxy company given to you. Number A, if beta of a proxy, if beta of a proxy is given, then in that case, there are 3 steps you are going to carry out to calculate your cost of equity on gear. Step 1 would then be to identify the proxy beta. Identify the proxy beta. Then step 2, let me see. Okay, let me use Roman figure. Step 2, you ungear the beta. The same way you normally ungear beta under project specific. Yeah, So depending on whether you are given debt beta or debt beta is assumed to be risk-free, you already know the formula to use to ungear. Then step 3, we calculate cost of equity. Calculate cost of equity on gear. I've already mentioned that up there. KEU. All right. You calculate cost of equity on gear. Okay. So these are the 3 procedures you are supposed to carry out anytime you want to calculate cost of equity on gear where beta of a proxy company is given to you. If you like, you can give it acronyms: PUC, POC. P represent proxy beta. U represents on gear, then C represents capping. All right, calculate cost of equity on gear using capping. Okay, using capping. So these are the 3 procedures you are supposed to carry out to calculate cost of equity on gear. Then number B, if cost of equity of a proxy is given, if cost of equity of a proxy is given, then in this case, you are supposed to use Miller and Modigliani formula to calculate your cost of equity. You recall when we had cost of capital, traditional WACC, I told you that there are 3 ways you can calculate cost of equity. You can either use dividend valuation model, 2, capital asset pricing model, then 3, Miller and Modigliani. And I told you specifically that when we get to adjusted present value, that we are going to use the Miller and Modigliani formula. So in this case, whenever you want to calculate cost of equity using Miller and Modigliani formula, you then say cost of equity of a gear is equal to cost of equity on gear plus, open a bracket, cost of equity on geared minus cost of debt. Let me write that, minus cost of debt multiplied by debt value multiplied by 1 minus tax of a proxy divided by equity value of a proxy. Okay, so that's that. This is the formula for calculating cost of equity on geared. So on that day, the cost of equity of a gear will be given to you. What you are looking for is the cost of equity on gear. So you are going to use the known variable to get the unknown. All right. So on that day, you will say it. Okay. So that's basically that. Then the third one, the third way of calculating your cost of equity on gear is if the WACC, if WACC of a proxy is given. So if you are given WACC of a proxy, let me give space. All right, number C. If WACC of a proxy is given, so where WACC of a proxy is given and you want to calculate cost of equity on gear, then in that case, just say WACC of a gear equal to WACC of on gear multiplied by 1 minus debt value multiplied by tax rates all over equity plus debt. So this is the formula that you are supposed to use. This is the formula that you are supposed to use to calculate the cost of equity of on gear. Okay, so that's that. Note that WACC of on gear is equal to cost of equity on gear. All right, let me just define the variable where, let me start from the beginning. We started with KEG. Okay, this is cost of equity of a gear company, of a geared company. Then we have KEU. I think I've already defined this. This is cost of equity, on gear. Then we have KD, cost of debt. You already know this. KD, cost of debt or cost of borrowing. Okay. Then we have D, debt value. Debt value of a proxy company. E equal to equity value of a proxy company. What is tax? T equal to tax rate of a proxy. Okay. What is then? Of course, D. I've already said D is debt value. So I think that's it. That's it. So that's that. Now, you remember, we are still doing base case NPV. So the third step of base case NPV is to calculate the present value. So step 3 now. Step 3, calculate present value. Then step 4, you already know how to calculate present value. So present value of cash inflow and cash outflow. Then step 4 is to calculate base case NPV. Determine base case NPV. How do you do this? This is calculated as present value of cash inflow minus present value of cash outflow. Okay? This is calculated as the difference between present value of cash inflow and present value of cash outflow. Okay, so that's that. So with this, you are done with base case NPV. Like I said, the base case NPV will be calculated the same way as you normally do whenever you are calculating NPV. The only difference is just that you are, instead of used to use the company WACC to evaluate the project, you are supposed to calculate cost of equity on gear. All right, that's just the difference. Once you know how to calculate cost of equity on gear, then you are good to go. Now, like I said, this cost of equity on geared, only one of the three informations will be given to you on the day of the exam. All right. Once you can see in the question that once you are given the debt beta of it, once you are given beta of a proxy company, that means you are supposed to follow these three procedures. All right. But if in the question you are given cost of equity of a proxy company, then you need to use Miller and Modigliani formula to calculate the cost of equity on gear. All right. Then the third way you can calculate your cost of equity on gear is if you are given the work of a proxy company. Then in this case, you are supposed to use this formula, of course. And I think Mr. Ashwaji might have used this formula for you when he was taking you theories of journey. Okay, all those two most controversial guy, Miller and Modigliani. Theories of journey. Okay, proposition 1, 2, 3, or whatever. All right, then let's move on from here. So this is how to calculate how to calculate base case NPV. Then the second part of your APV, the second procedure is to calculate the present value of financing effect cash flow. Okay. Number B, calculating present value of financing effects cash flow. Now, when you want to calculate PV of financing effect cash flow, there are three procedures. In fact, I will make it 5 procedures, then I will explain it one by one. All right, so steps. Step 1, whenever you want to calculate present value of financing effects, you need to establish ab initio. Which cost of capital do you want to use to evaluate the cash flow or to discount the cash flow arising from financing? Because Miller and Modigliani are the two guys that propounded this, that established this adjusted present value. And the two of them, they failed to tell us which cost of capital to be used to discount the cash flow arising from financing. Therefore, you are at liberty to either use cost of borrowing or risk-free rate of return. Usually, cost of borrowing will be higher than the risk-free rate of return. I will advise you on the day of your exam, always use cost of borrowing as your discounting rate for the cash flow arising from financing. So the first thing you need to do on that day of your exam, you want to calculate APV, because APV could be a compulsory question. So that means you have no choice. You just have to solve it. So the first thing you need to do is to ascertain whether you want to use cost of borrowing or risk-free rate of return. Okay, ascertain if you want to use cost of borrowing, that is normal borrowing rates, normal borrowing rates, or risk-free rate of return. Okay, so that's that. So once you have established this from the beginning, then you should know you are not using the company cost of capital. It has to be either cost of borrowing or risk-free rate of return. Then another thing you need to know, you need to decide. Let me use figure. Another thing you need to decide is whether you want to use gross finance require or net finance require for the cash flow arising from net subsidy and then tax saved on interest. Okay, decide if you want to use gross finance require, GFR, or net finance required, NFR, for the cash flows arising from net subsidy. Let me rewrite it. Net subsidy or tax saved on interest. Okay, so this is important. All right. So you need to know if you are using gross finance required, you need to decide that or whether you want to use net finance required. Okay. Because oftentimes examiner will just be silent. If examiner is silent, you are not told whether to use gross finance or net finance. Then you just go ahead and use gross finance required to be on the safer side. All right. Always use gross finance required. Okay. So how do you then calculate net finance required? Note, net finance required is calculated as the initial outlay plus working capital. Okay. Then the gross finance required is calculated as the net finance required divided by 1 minus issue cost rates. Okay. Note, ICR equal to, okay, I will define it later on. Let me just move on. Okay, so that's what you need to do. I will explain what you mean by issue cost later on. Then step 3 now. Step 3, you need to calculate present value of issue cost. Calculate present value of issue cost. So you only calculate present value of issue cost if in the question you are given issue cost. Where you are not given issue cost, you don't need to do that. At times, I've already told you, you only calculate APV where issue cost or subsidized loan is given. So if in the question you are given both issue cost and the subsidized loan, then you need to do that. But at times, examiner may not give to you issue cost, but you are going to be given subsidized loan. At times, examiner may not give to you subsidized loan, but you'll be given issue cost. So when you see those information, you should know what to do. Right. So how do you then calculate the PV of issue cost? First thing first, you need to know what is issue cost. You know, when a company wants to raise money in the market, let's say, for example, a limited liability company is now going public. You want to you want to go for initial public offer. So you want to raise capital in the market. So before the company will receive the finance required, there will be some costs that the company will incur. So because of time, let me limit so that we can finish on time. All right. So let me just write down the meaning of issue cost. So issue cost represents, okay, represents the cost associated, the cost associated with underwriting, with underwriting and raising debt and equity capital. Okay, that's issue cost. Now, whenever you want to, like I was trying to explain, anytime you want to raise capital in the market, there will be some underlying costs that the company will incur. So those underlying costs, before you receive the finance required, is what is known as issue cost. Examples of issue cost include number one, let me just put asterisk. When a company wants to raise finance, the company cannot go to the market directly. There will be some intermediary that will be operating on behalf of the company. Therefore, the company will pay for investment banking fee. All right, investment banking fee. Okay. Not only that, when a company is operating in the capital markets, you must register with the Security and Exchange Commission. So the registration fee that you are going to pay to SEC is part of issuing cost. Okay, so you can say registration fee or regulatory fee, whatever you want to call it, e.g. payment to SEC. Then next, another example of issue cost is marketing expenses. You know, say for example, if a company wants to wants to go through IPO, initial public offer, you will see that that offer will be marketed, will be promoted in the media, on social media, in the on national TV and all of that, just to sensitize the public, to encourage the public to subscribe to the company's shares. All right. So of course, all those expenses is not for free. The company must pay for them. Not it's not the it's not the intermediary. It's not the investment banker that will be incurring the expenses on their own. So the company must pay for it. All right, because if you don't market it, if you don't promote the offer, certainly uh, not many people will be aware of it, and then the company may not be able to raise the required capital from the public. Okay. Not only that, there is also what we call professional fee. Okay, professional fee. Okay, e.g. the audit fee. Not only audit fee, you also pay legal fee. All right. So before the company goes public, when you are raising the capital, your financial statement will need to be audited. So the auditor that will work on your financial that will review and provide opinion on your financial statement will need to be paid. Not only that, the lawyers will also need to work on the offering. All right, we need to work on the what are the legal uh, consideration. What are the legal considerations on the relating to the offering. So of course, it's not for free. You need to pay the lawyers as well. So these are some of the expenses. These are some of the costs associated with issuing costs. Now, before the company receive the required finance, you can see all these expenses are from the beginning. All right, all these expenses they are from the beginning before the company will receive the required capital or the required finance. So that means that what the company receive at the end of the day is the net amount. Okay, is the net amount. So let's say, for example, all these expenses are like 5% of the total finance required. So that means only 95% is what the company will receive to finance its operation. Okay, so that is basically issue cost. But one thing you need to know is that, okay, additionally, let me just put it down. Yeah, the issue cost, there are two stages of calculating present value of issue cost. Okay, let me just give you the format once and for all. So now, whenever you want to calculate PV of issue cost, you go to the question. At times, examiner can give it to you. You can be given debt and equity. All right. So you calculate issue cost on debt, issue cost on equity. So the first step to calculate issue cost, present value of issue cost. Step one is to determine the issue cost amount. Determine the issue cost amount. ICA. That's step one. Issue cost amount on equity or on debt and equity. If the two of them are given to you, because examiner will give to you issue cost rates on debt separate, issue cost rates on equity separate. So once you are given different issue cost rates, then in that case, you need to calculate two different issue cost amounts, both for equity and debt. Then step two, you then calculate PV of issue cost in year 0. Calculate PV of issue cost. Let me call it PV of issue cost amount in year 0 for both equity and debts. Okay, for both equity and debts. In this case, I will say issue cost amount on debts, which will be equal to issue cost amount multiplied by discount factor at year 0. Whatever you have, keep it there. It will always be in brackets because it's a cost. Okay, let me rewrite this. Then also, you calculate issue cost amount on equity. So you pick the issue cost amount on equity, you discount it with the appropriate discount rates in year 0. All right. Then, additionally, you also need to calculate. You need to calculate if in the question you are told that the issue costs will include tax relief or tax benefits, then you need to determine, you calculate or determine the, let me write it. What's wrong with you? Determine the tax saved or tax benefits. Tax saved on issue cost amount on the debts. Let me put it on the other side. Issue cost amount on debts in year 1 only. Okay, how do you do this? You know, anything that has to do with tax saved. So you multiply that thing with company tax rates. So I would then say tax saved is equal to the issue cost amount on debts multiplied by company tax rates multiplied by discount factor of year 1. So this one will be positive. This one will be positive. So at the end of the day, you find the net amount. So you find the net amount. Usually it will be negative. All right, so this will then give you the PV of issue cost. Okay, so that's how to calculate the present value of issue cost. All right, but in most cases, it will be issue cost on debt. The one of equity is not common, but if you are given the one of equity, just do it the same way you have in this format is the same way you are going to calculate it. Then, for the PV of financing effects, so the step 4 now, let me use Roman figure here. Roman figure 1. Roman figure 2, Roman figure 3. Then the step 4 of calculating PV of financing effect. Step 4 is to calculate PV of net subsidy. We're almost there. How do you calculate PV of net subsidy? There are 4 procedures. Step 1, I've already broken everything down step by step for your understanding. So step 1 is to accumulate all, no, before that, step 1, calculate subsidy amounts. Okay, SA. Now, when a company is requiring finance, okay, when a company requires finance, that finance can become through normal borrowing or through subsidized loan. Usually, subsidized loan is cheaper. The interest rate paid on the subsidized on subsidy is cheaper than the interest rate the company will pay if you borrow in the market. When you borrow in the market, that is normal borrowing rate. Okay, so when you are calculating APV, especially when you want to calculate PV of net subsidy, the first thing you need to do is to calculate the subsidy amount. You want to know out of the total finance required, how much relate to what's the proportion of the subsidy. So that will give you the subsidy amount. So SA is equal to the gross finance required multiplied by proportion of subsidy. Okay, examiner will surely tell you the proportion of the subsidized loan. Say, for example, out of 100% of the finance required, examiner can tell you that 50 or 60% is for subsidy. If 60% is for subsidy, it means that the balance of 40% is true normal borrowing. If you are told that subsidized loan is 70%, it means that normal borrowing is 30%. So you need to know how to interpret this. Then step number two under net subsidy is to determine savings on subsidy. Determine savings on subsidy in percentage. Okay, SOS in percentage. How do you do this? The SOS percentage is calculated as the difference between the interest rates in the markets and the interest rates through subsidized loan. So you have normal borrowing rates minus interest rates on subsidy, that is subsidy rates. Okay, the difference between the two will give you the savings on subsidy. Then number three, you then calculate net subsidy, NS. How do you calculate net subsidy? Net subsidy is calculated as subsidy amounts multiplied by savings on subsidy in percentage, okay? Then multiply by 1 minus tax, okay? So that will give you the net subsidy. Finally, step 4, you then calculate PV of net subsidy. All right? So PV of net subsidy will then be equal to the net subsidy multiplied by annuity factor. Okay, so these are the 4 procedures you are going to carry out anytime you want to calculate the PV of net subsidy. Finally, step 5 before the final one. Step 5, so you calculate PV of tax saved on interest. Okay, how do you do this? There are 3 stages, 3 steps. Step 1, you accumulate all interest elements. Accumulate all interest elements. What do I mean by that? You need to calculate interest expense attributable to normal borrowing and then subsidy. Okay, so to do this, so you determine interest on normal borrowing. Okay, whatever it is, put it there. Then interest on subsidy. Interest on subsidized loan. Then you add the two together. That will give you total interest. How do you get the interest? Just multiply interest rates on normal borrowing with the amount borrowed in the market. Interest rates on subsidy multiplied by subsidy amount. We give you the interest on that. Then step 2 is to calculate tax saved on interest. Calculate tax saved on interest. How do you do this? You know, anything that has to do with tax saved, what do? You then pick the total interest in step 1. You multiply with the company tax rates. Then finally, step 3, you calculate PV of tax saved on interest. How do you do this? Very simple. The PV will then be equal to the total tax saved, all right, tax saved on interest multiplied by annuity factor. Okay, so these are the 3 procedures you are expected to carry out anytime you want to calculate PV of tax saved on interest. Step 6 is to calculate adjusted present value. Determine adjusted present value. How do you do this? Very simple. Sorry, determine PV of financing effects. Financing effects. So under this, all the calculation that you have done in step 3 to 5, then you need to bring it down. So the calculation you have done for calculating you have done on the issue cost, net subsidy, and then tax saved. You need to bring it down here. So here will be PV of issue cost, whatever it is, plus then PV of net subsidy is a plus. Finally, PV of tax saved on interest is also a plus. At the end of the day, you can either have positive or negative from financing. So this is the PV arising from financing effects, cash flows. So this is how to calculate PV of financing effects, cash flow. All right. Then step C now. You know, step B is to calculate PV of financing effect. So step D. So step C is to calculate the APV. Okay. Step C, calculate adjusted present value. To get adjusted present value, you've already done the major work. Okay, you've already done the major work. So in this case, adjusted present value will be calculated as base case NPV whatever you have. Then you had this, you can base case NPV plus minus PV of financing effects. Okay, PV of financing effects, cash flow. This could be positive or negative. So at the end of the day, your APV could be positive or negative, just like your normal NPV. So that is the adjusted present value. Then of course, step D says you should advise. You should advise. So decision rule under the decision rule here is the same thing as decision rule for NPV. Okay. You advise if the project should be accepted if APV is positive. All right? Accepts if APV is positive. But if APV is negative, you reject. Rejects if APV is negative. If you have 0 APV, then you refer to other qualitative factors. All right. So that's basically adjusted present value right on time. All right. So this is how to calculate adjusted present value. So yes, in our next class, by the grace of God, we are going to be solving, we can't solve more than one illustration because it's usually a big one. All right. So we can't solve more than one. But in any case, until then, let me know if you have any question for me so that we can close the class for today. Let me see. Okay, only a few of you have left so far. Yeah, any question for me so that we can close the class? All right. So in the absence of no further question, I want to say thank you to every one of you and then for waiting behind. By the grace of God, in our next class, we are going to spend about 1.5 hours to solve the illustration we have on this. Then thereafter, we move to a brand new topic, which is risk and uncertainty. So after APV, we are moving to risk and uncertainty. So you can go ahead and read about risk and uncertainty. All right. So thank you, everyone. Good night.
Good night, sir.
Yeah,
Good night,
Uju.
Thank you. Good night.
Good night. Good night, everyone. Okay.